Welcome back, everyone. My name is Ed, and this is the Soaring Dividend YouTube channel where we discuss dividends and other passive income investing. In today's episode, we're going to switch things up a little bit. We're going to talk about my top 6 ETFs, and these include growth ETFs and dividend ETFs. I was recently asked by my sister, what are some constant income streams that I can buy within the stock market that will give me that level of diversification and reassurance that they will go up over time? And I immediately thought of an ETF in my mind. So without further ado, let's head over there and look at my top 6 ETFs and what an ETF truly is. All right, so what is an ETF? An ETF is basically a collection of stocks, bonds, or companies that all fall under a single ticker symbol or fund. An ETF can be targeting a specific index, such as the Dow Jones or S&P 500, or you can have something that's more industry focused, so targeting the technology sector. Apple, Microsoft, Google, you name it. All right. There are some clear benefits of ETFs, and I'm going to name 4 of them really quick before I go over my top 6 ETFs. So here they are. The first benefit of an ETF is that diversification is on your side. You can have a 40 company ETF and say a couple of the stocks are underperforming, so 1 or 2. If 1 or 2 are underperforming, the other 38 are probably going pretty well. So instead of a balance, you're going to have your ETF go up over time if the majority of the stocks are performing well, okay? Not only diversification is key, but you don't have to necessarily look at a single company. So if you had just invested in a company like Apple and Apple stock fell the next day and you were down, say, $1,000 from your initial investment, if you had an ETF with Apple in it, then your ETF might not even drop because you could have Google at a higher weight than Apple, all right? So diversification is key, and I strongly believe that if you are concerned with investing in a single company, ETFs are the way to go. All right, the second benefit is you can do little to no research at all in an ETF. You can just target a specific industry that you want to invest in, and you don't necessarily have to even look at the companies in it, even though I highly suggest that you look at the top 10 companies in it, because that is where your highest weighted distribution is at, all right? So you don't have to look at the company's financial statements if you don't want to. You can just let your ETF ride over time. The third benefit of an ETF is that ETFs are typically less expensive in terms of their expense ratio than a mutual fund. So an expense ratio is basically what you pay to the fund's manager for managing the 40 to 100 to 400 companies within that ETF. All right, you're paying that manager a portion of your profits to manage your fund for you over time, okay? A mutual fund might have a higher expense ratio, such as, I don't know, anywhere from like 0.5% to 4%. An ETF, on the other hand, could have 0.06% of an expense ratio up to 0.5% of an expense ratio if you're targeting more popular ones, such as ones by Cathie Wood, for instance. So ETFs, lower expense ratio, which is awesome. The fourth benefit of an ETF is that ETFs still pay dividends. So if you're invested in an ETF with, say, 5 or 10 dividend companies, you're still going to get those dividends back to you on the quarterly reports, or however frequent that you're going to get those dividends for the companies. So that is an awesome thing because there are dividend ETFs, and I'll talk about 3 of my top favorite ones right now. So here we go. All right, so enough chit-chatting on what an ETF is. We're going to look at my first dividend ETF that I think has huge potential. That is SCHD. All right, SCHD. Let's go over to ETF.com to take a look at it. So search up here, SCHD. It's a Schwab US dividend ETF that we're looking at right now. So a couple things to note here. It has an expense ratio of 0.06%, so almost nothing just to be a part of this ETF that's really well diversified. Next up, we have assets under management of about $25 billion. That means this ETF manages $25 billion worth of stocks, US companies. So a big $1 billion ETF is usually more reliable than those small $1 million ETFs that you're going to find out there. All right, so you're also going to see that it has a distribution yield right now. So a dividend yield of about 2.7%, which is not that bad for an ETF to be in. And let's look at a couple more things down here. You'll see that, look at the 5-year rate of return here. So back in 2017, the stock was about $43, and now it's climbed to almost $80. So that's a really, really good rate of return here. And then lastly, let's look at the top 10 holdings. I always look at this when looking at ETF to see if it fits my boat in my portfolio. So you see Home Depot, IBM, Cisco, BlackRock, Pfizer, Texas Instruments, PepsiCo, Coca-Cola, Broadcom, and 3M are the top 10. All of these are well-established companies, and I have quite a bit of these in my own portfolio as individual companies and individual stocks. All right, so SCHD looks pretty good. Let's go check another one. Let's do HDV. So iShares Core High Dividend Yield. All right, so this one is going to have a little bit more expensive, but almost nothing expense ratio of 0.08%, nothing at all. It's a $7 billion asset base, so still really well established. Scroll down the page, you're going to see that they have a yield, a little bit higher yield than SCHD of about 3.5%. So that's really good for a dividend ETF. Let's look at the 5-year rate. So it's a lot steadier, a little bit flatter than SCHD, but this is growing over time, which is exactly what we want to see. All right, in the top 10 companies, you have ExxonMobil, JP Morgan Chase, Johnson & Johnson, Verizon, Chevron, Procter & Gamble, Cisco, and Coca-Cola, and Altria, and then the Merck & Co. Inc. So again, really established companies here. You're just going to have a different diversification class, so a different sector switch up, essentially. So this one seems to be more heavy on financials and telecommunications. All right, so again, this one looks pretty good to be a part of as well. The next and final one for the dividend ETFs I'm going to talk about is my favorite one, is VYM, the Vanguard High Dividend Yield. All right, so let's scroll down the page here. You're going to see that this one has a really nice 5-year trend line going on. Okay, they have a 0.06% expense ratio, really nice. $38 billion asset management, really good dividend established. Dividend yield is about 2.8%. Really nice to see that. And then finally, the top 10 holdings, JP Morgan Chase, so Johnson & Johnson, Home Depot, Procter & Gamble, Bank of America, Comcast, ExxonMobil, Verizon, Intel, and AT&T is their last one. So I don't know if you guys heard of the news about AT&T, but if you're watching this channel, then you probably have. They are cutting their dividend pretty substantially soon with their merger with Discovery. So I'm happy that this is only a small percent here for now, but VYM looks fantastic. It's really well diversified. You see that the highest weight is only 3.5%. So a couple of the other ones had like 4.5 or 5% weight as their top one. So this one is going to be more diverse over time, which is really nice to see. So these are the dividend ETFs. So again, these will give you back your dividends every single quarter. Okay. And again, these ones, dividend ETFs are not necessarily going to be a high trend line like the growth ETFs I'm about to show. So take that into consideration, and let's head over there right now. All right, so the first growth ETF we're going to run through is a little bit faster is going to be QQQ, or the Invesco Trust. All right, so let's go here. These are going to have a little bit more expensive expense ratios, but that's how it happens with growth stocks. So 5-year return, looking fantastic right there. All right. And over time, you're more than likely going to get your money back, but don't take my word for it. I'm not a financial advisor by any means necessary. This is just for fun for me. All right, so their expense ratio is 0.2%, so a little bit more expensive, but they manage $160 billion worth of assets. So pretty substantial. They have a low dividend yield right now of 0.53%. It's more of a growth ETF. And their top 10 holdings, here we have Apple, Microsoft, Amazon, Facebook, Google, Tesla, NVIDIA, PayPal, and Comcast. So pretty nice ETF to look at right here. All right, the next one we have is VGT. VGT, the Vanguard Information Technology ETF. So a lot of similar companies you're going to find in here. All right, so let's look at the 5-year rate. So pretty good, looking pretty good. Expense ratio 0.1%, not as high as QQQ's, so a little bit better in my opinion, but they manage less assets at $44 billion. They have a little bit higher dividend yield of 0.7%, still pretty low if you're looking at dividends. And then the top 10 holdings, you have Apple, Microsoft, NVIDIA, Visa, MasterCard, PayPal, Adobe, Intel, Cisco, and Salesforce. So this one also looks pretty good to be in. And then the last one I'll be talking about today is VUG, the Vanguard Growth ETF. Okay. So you're gonna see that they have expense ratio of 0.04%. That is a really good expense ratio, especially for growth companies. They manage $74 billion worth of assets right here. Okay, they have a yield of 0.6%, not that high. Let's look at their 5-year line chart. Pretty good right here. Actually really good. And then the top 10 holdings, you can have your same companies, your Apple all the way to Facebook, and then Home Depot slid in there as well. So out of these three, the most attractive one is either QQQ or VUG, in my opinion, just from a trend line perspective. But VGT also looks really, really nice with a lower expense ratio as well. All right, so that is it for the dividend and growth ETFs. All right, I hope you guys enjoyed that one. And these are only my top 6 out of thousands of ETFs out there. So do your own research and don't be afraid to just explore and search ETF.com for hours if you want, depending on how much research you want to take in. But I'm not a financial advisor. This is for entertainment purposes only. And I just do this for the fun of it, guys. I want you all to succeed as well as myself to succeed. So I picked the top 6 ETFs for you today. All right, without further ado, guys, I will see you in the next one. My name is Ed.